Good afternoon, ladies and gentlemen, and welcome to Richelieu Hardware second quarter results conference call. At this time, all participant lines are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, which will be restricted to analysts only. And if at any time during this call you require immediate assistance, please press *0 for the operator. Also note that this call is being recorded on July 9th, 2026. Bonjour, mesdames et messieurs, et bienvenue au résultat du deuxième trimestre 2025-2026 de Quincaillerie et Richelieu. Présentement, vos lignes sont en mode d'écoute seulement. Suite à la présentation, nous allons procéder à une période de questions et réponses qui sera restreinte aux analystes seulement. Si vous avez besoin d'assistance au cours de l'appel, s'il vous plaît, appuyez sur l'étoile et le 0. Veuillez prendre note que cet appel est enregistré le 9 juillet 2026. J'aimerais maintenant céder la parole à M. Richelieu, président et chef de la direction. La parole est à vous.
Merci. Thank you. Good afternoon, ladies and gentlemen, and welcome to Richelieu's conference call for the second quarter and first half ended May 31st, 2026. With me is Antoine Auclair, CFO and COO. As usual, note that some of today's issues include forward-looking information, which is provided with the usual disclaimer, as reported in our financial filings. We recorded good growth and positive results during the second quarter. We have remained focused on acquisition strategy, completing one new acquisition, followed by two further ones after the end of the quarter. Three promising acquisitions, meeting our criteria and further strengthening our leading position in this high-growth market segment. Thanks to steady growth in our main market segment in Canada and the US, our sales increased respectively by 5.5% and 4.4% in US dollar for the US sales, for total sales of $532.1 million, up 3.9%, an increase that would have been 5% on a comparable currency to 2025. Our sales to manufacturers accounted for 89% of our total sales, reaching $473.7 million, up 3.8%, driven equally by internal growth and acquisitions. Our sales to retailers and renovation superstores increased by 4.2% to $58.4 million. EBITDA reached $56.1 million, and net income attributable to shareholders was up 3.2% to $23.2 million. Regarding the execution of our acquisition strategy, since the beginning of the year, we have completed 4 acquisitions. One in the US during the first quarter, another in Quebec during the second quarter, and 2 additional acquisitions after the end of the quarter in Canada. On May 1st, we acquired Finium, a distributor and manufacturer based in Frampton, Quebec, specializing in premium wall covering panels with high aesthetic, decorative, and acoustic value. These products stand out for their unique design, quality, and installation ease for both residential and commercial application, and they fit perfectly with our decorative panel offering. On June 26th, we completed the acquisition of Solution Acoustic, which operates in the Greater Montreal and as a specialized distributor in acoustic solutions known for their performance and architectural design. Then, on July 8th, we completed the acquisition of Winnec, a distributor of specialized hardware operating in the GTA area with 3 distribution centers. This reinforces our position in the key market of Ontario. These 4 acquisitions, completed since the beginning of the year, add approximately $45 million in annual sales, bring new value expertise, new products, new customers, and further enhance the value we provided to our customers. In fact, the addition of Finium and Solution Acoustic strengthens our leadership in decorative and acoustic solutions to high-growth market segment, while further expanding our presence among architects and designers. This strategy builds on the recognition we received earlier this year with our Best of KBIS awards in 2 different product categories, and it reflects our commitment to differentiate ourselves and remain a leader in innovation. I will now ask Antoine to review the financial highlights for the quarter and the first 6 months.
Thanks, Richard. In the second quarter, sales reached $532.1 million, up 3.9%, or $19.9 million, driven by 1.8% internal growth and 2.1% from acquisitions. At comparable exchange rates, sales growth would have been 5%. In Canada, sales totaled $291 million, up 5.5%, despite flat sales in Ontario, where the market conditions remain more challenging. Sales to manufacturers amounted to $246 million, up 4.5%, while sales to the hardware retailers totaled $45 million, up 11.6%. In the U.S., sales grew to $175 million in U.S. dollars, up 4.4%. Sales to manufacturers reached $166 million in U.S. dollars, up 5.6%, with 3.1% coming from internal growth. In the hardware retailers and renovation superstores market, sales reached $9.6 million, down 12.7%. In Canadian dollars, total sales in the U.S. reached $241 million, up 1.9% over last year, and accounting for 45% of total sales. Sales to our U.S. manufacturers market now represent 48% of total sales to manufacturers, further reflecting the growing importance of our U.S. operations. For the first half, total sales reached nearly $1 billion, up 4.4%, of which 1.9% resulted from internal growth and 2.5% from acquisition. In comparable exchange rate, sales growth would have been 5.9%. In Canada, sales reached $541 million, up 4.5%, including 2.9% from internal growth and 1.6% from acquisition. Sales to manufacturers totaled $452 million, up $21.6 million, or 5%. Sales to hardware retailers and renovation superstores were $88.7 million compared to $86.8 million, up 2.2%. In the U.S., sales amounted to $331 million in U.S. dollars, up 7.5%, with 3.7% from internal growth and 3.8% from acquisitions. They reached $455 million in Canadian dollars, up 4.2%, accounting for 46% of total sales. In U.S. dollars, sales to manufacturers totaled $313 million, an increase of $23.2 million, or 8%, driven by 4.5% internal growth and 3.5% from acquisitions. Sales to hardware retailers and renovation superstores stayed the same compared to last year. Second quarter EBITDA reached $56.1 million, up $1 million, or 1.7% from last year. EBITDA margin was 10.6% compared to 10.8% last year. Slight decrease in percentage reflects the impact of tariffs, which proportionately increased both sales and cost of sales. First half EBITDA totaled $99.4 million, up 1.8%, with the EBITDA margin at 10%. Second quarter net earnings attributable to shareholders amounted to $23.2 million, up 3.2%, while diluted net earnings per share increased 2.4% to 42 cents from 41 cents last year. First half net earnings attributable to shareholders reached $37.6 million, up 3.5%. Diluted net earnings per share stood at 68 cents compared to 66 last year. Second quarter cash flow from operating activities before net change in non-cash working capital reached $47.9 million, up 2.4% from $46.8 million last year. Change in non-cash working capital used cash flow of $28.5 million, primarily driven by a $14.8 million increase in accounts receivable and a $9.4 million increase in inventories. As a result, operating activities generated a cash inflow of $19.4 million for the quarter. For the first half, cash flows from operating activities represented a cash inflow of $36.6 million, compared to a cash inflow of $51 million last year. For the second quarter, financing activities used $33.5 million in cash compared to $23.3 million last year, primarily reflecting higher cash return to shareholders through $7.6 million of common share repurchase, in addition to quarterly dividend payment of $8.6 million. First half financing activities used cash flow of 58.6 million compared to 44.7 million in 2025. In the first half, we invested 26 million, including 15.3 million for 2 business acquisitions and 10.7 million primarily for equipment required to maintain and improve operational efficiency, including IT equipment. We continue to maintain an outstanding balance sheet with working capital of 629.5 million. I now turn it over to Richard.
Thank you, Antoine. In conclusion, we are integrating our acquisitions while the current economic environment is creating attractive acquisition opportunities in our target markets. We are evaluating several opportunities and remain well positioned to pursue those that meet our strategic criteria and support our long-term growth. We continue to differentiate ourselves by constantly expanding our product offering and bringing innovative solutions and emerging global design trends to the American market. By introducing products that are first to the market and maintain of them exclusive with our own brand names, and many of them being exclusive with our own brand name. We have become a trusted partner for architects, designers, woodworking professionals, and retailers. This relentless focus on innovation, product leadership, and value-added service, combined with the strongest team and a strategically located distribution network, is what defines Richelieu, reinforcing our competitive advantage and help our customers being more successful in their own business. Thanks, everyone. We'll now be happy to answer your question.
Thank you, Mr. Lau. Ladies and gentlemen, if you do have any questions, please press star followed by 1 on your touchtone phone. You will then hear a prompt that your hand has been raised. And should you wish to decline from the polling process, please press star followed by 2. And if you're using a speakerphone, you will need to lift the handset first before pressing any keys. And a reminder that questions are restricted to analysts only. Thank you. Please go ahead and press star 1 now if you have any questions. First, we will hear from Hamir Patel at CIBC. Please go ahead.
Hi, good afternoon. Richard, can you share how sales fared in the month of June, and any differences there across categories or geographies? And I think last time you kind of highlighted Ontario as being particularly weak, so any signs of turnaround there?
I think the sales performance is probably the same performance that we had until in the last quarter. So what we see, Canada is doing well as a whole, except for Ontario. I think Quebec is doing very well with a sales increase by more than 10%. Western Canada is also very healthy. I think it's over 5% increase. So basically, except for Ontario, Canada is pretty good. Ontario, I would say, in the U.S., it's about the same everywhere, but we have different market segments, like the specialized market, like the closet market, for example. We continue to experience sales between 15 and 20% increase. For the rest, we have basically a performance of 2 to 3% per market segment. So basically, we're satisfied with that. But I think we have what we have decided here in this company is that maybe to invest a little bit more in sales people, mainly in the U.S., in order to gain more customers and to move the market. We think the market is in a kind of lethargy as we speak. So I think we have to be more aggressive in visiting more customers and acquiring new customers and as a result, new sales as well. So basically, we don't think that the months to come in the near future will help us. So we have to help ourselves by removing the sales.
Fair enough. And Richard, how much is Ontario as a percent of your Canadian business? Is that 40, 50%?
44%.
44%. Okay, great. And I know, I think, yeah.
I make it 17% of total sales.
Of total sales, including US, everything. Yes.
Right. Okay. And then I know, I think, Richard, in the past, you highlighted some US box business that was going to resume. I think it was supposed to start in Q2. Is that only playing out here in Q3?
Yes. It has started. So we're in the process of delivering our first order. So basically, that's going to create more sales really for a couple of quarters. After that, it's going to be really flat for a couple for the next quarters, because once we fill up the stores, it takes a while before the order. But after that, it's going to be you can imagine $10 to $12 million sales, yearly sales.
And it started in June.
June. Perfect. Okay. And just last question I had, Antoine, your EBITDA margins averaged 10% in the first half. On the last conference call in April, you're pointing to an 11% average for the year. Is that 11% still looking achievable? And what type of demand backdrop would you need to get margins to that sort of longer term 12-13% objective?
Yeah, we would need a bit more rigor in the market to pump up those margins. But keep in mind, Amir, that the second half is always stronger than the first half, and you understand as well that the very slight decrease, 0.2, is basically due to tariff, because when we're passing through the tariff, we're passing the dollar, so it has for sure a slight dilution on the percentage. We should be able to be close to the 11%. But we will need a bit more rigor in the market.
Okay, fair enough. That's all I had. I'll turn it over. Thanks.
Thank you.
Next question will be from Zachary Evershed at National Bank Capital Markets. Please go ahead.
Good afternoon, everyone. This is Nate calling in for Zach. Thank you for taking my questions today. I want to ask first on the margins. So was there anything else to call out on the margin compression year over year other than tariffs? Because we noticed your gross margins fell around 200 basis points year over year, but your EBITDA margins only fell 20 basis points.
No, there's nothing else than that. So structurally it's the same. So really the tariffs is definitely what has impacted the margin.
I see. Okay. And with the aforementioned 11% EBITDA margin goal, how are you feeling about that on top with recent acquisitions now in the mix and the few, I believe several you have currently evaluating in your pipeline?
Yeah, some of the one we closed last year were businesses that we acquired that needed some restructuring. The one that we announced this year in the second quarter are businesses that are generating EBITDA already. So we're confident about these acquisitions. So the one we just did will not dilute the EBITDA margin.
Thank you very much. And we did notice also that capital expenditures ticked up to $7.5 million this quarter. Are there any plans you can tell us about?
Yeah, no, basically, there's a $2 million of IT equipment that we have to make every 3 to 4 years. So except that, it's pretty much back to maintenance capex. So we should be at the end of the year, we should be between 18 and 20 million, like we told you guys earlier. So we should be around that. We're looking at a few projects. So we're looking at increasing our footprint in our Drummondville location. So as you know, we have a building there. We have a land available. So we're gonna have some lease expiring, and we're gonna be building in Drummondville, Quebec. So that should occur at the end of the year and the beginning of next year. But else than that, there's nothing else to mention.
Great color. Thank you. And one last one for me. How are you guys feeling about your working capital position? And do you have any targets you'd like to call out for this year or next year?
Well, I think working capital is pretty simple. It's accounts receivable and inventory. So I think on the AR side, we're in good shape. We have a day of sales outstanding around 45, 46 days, which is pretty aligned with historical levels. On the inventory side, you've seen increases in the first 2 quarters. We've also captured some opportunistic acquisition in terms of inventory. So before price increase, we've we've closed some deals to bring in the inventory at a lower price. So we've done that. So we should see a reduction in the second half. I'm hoping to see a reduction between 5 to 10 million in the second half.
Thank you very much. I will turn it over.
Thank you.
And at this time, Mr. Lau, it appears we have no other questions. Please proceed.
Thank you very much. It's very nice talking to you again. If you have any further questions, do not hesitate to call us. Thank you.
Thank you, sir. Ladies and gentlemen, this does indeed conclude your conference call for today. Once again, thank you for attending. And at this time, we ask that you please disconnect your line.